How the stock market affects your wealth. The stock market is a fundamental component of contemporary finance, and it plays a significant part in the formation of both individual and societal wealth. It serves as a marketplace for the purchase and sale of ownership holdings in publicly traded firms, providing individuals with the chance to maximize the growth of their savings, establish a foundation of financial stability, and accomplish their long-term financial objectives. With that being said, it is also a dynamic and complicated system that is influenced by a broad variety of circumstances, ranging from the performance of corporations to the conditions of the global economy. There are many different ways in which the stock market can have an effect on your wealth. Opportunities for growth are frequently balanced by the risks of volatility and uncertainty. Individuals have the opportunity to take part in the expansion of businesses and the economy through the process of investing in the stock market. When you buy shares in a firm, you will effectively own a portion of that company and will partake in both its achievements and its failures associated with that company. It is common for the value of a company's shares to rise as the company expands and generates profits. This, in turn, results in opportunities for shareholders to create profits. The process that is referred to as capital appreciation is one of the key factors that contribute to the creation of wealth in the stock market. One example is that if an investment is made in a company that is on a good growth trajectory, the value of the investment might potentially double or even treble over the course of a decade, providing that the firm continues to perform well and external conditions stay favorable. The power of compounding considerably boosts the potential for wealth creation that the stock market offers, in addition to the potential for capital appreciation. When the profits that are generated by your investments are reinvested, a snowball effect is created, which accelerates growth over time. This phenomenon is known as compound development. The reinvestment of dividends, which are periodic payments that corporations distribute to their shareholders from profits, is a particularly clear example of this phenomenon. Through the process of reinvesting dividends in order to acquire additional shares, investors have the ability to further magnify their returns. In the event that an investor receives a dividend yield of 3% on an annual basis and reinvests it alongside capital gains, the investor's portfolio may see exponential growth over the course of a few decades. In spite of the fact that it presents significant prospects for expansion, the stock market is nevertheless prone to volatility. There are many different variables that can cause fluctuations in stock values. Some of these factors include economic swings, geopolitical conflicts, and events that are special to the company. As an illustration, during the global financial crisis of 2008, stock markets all over the world witnessed large falls, which resulted in significant losses for a great number of investors everywhere. Those who are unduly dependent on the market for their short-term financial demands, or who do not have a diverse investment portfolio, are particularly vulnerable to the risk that being exposed to such volatility poses to their wealth. When it comes to limiting the risks that are linked with the volatility of the stock market, diversification is an essential technique. It is possible for investors to lessen the influence that a poor-performing asset has on their whole portfolio by diversifying their investments across a variety of businesses, sectors, and asset classes. Taking this method assures that the growth of some investments will compensate for the losses of other investments, which will ultimately result in a portfolio that is more stable and resilient over time. As an illustration, conservative companies such as utilities or consumer staples typically give stability during times of economic downturn, but technology firms may experience tremendous development during moments of innovation. A significant number of people also consider the stock market to be an essential component of their retirement preparation. Participants in retirement accounts, such as 401ks, IRAs, and other similar investment vehicles, frequently make substantial investments in the stock market. This enables them to accumulate wealth over the course of several decades by making constant contributions and taking advantage of the power of compounding. As a result of the long-term growth potential of equities, Even modest contributions made on a consistent basis have the potential to yield considerable returns over time. The generation of passive income is yet another potential way in which the stock market might have an effect on wealth. In particular, dividend-paying stocks provide a dependable source of income that can be used to augment incomes or funds for retirement. Even during times when stock values are either remaining unchanged or falling, these dividends offer a degree of financial security and predictability to the company. It is common for investors who concentrate their attention on dividend-paying companies of excellent quality to experience consistent cash flows. These cash flows can be reinvested to speed up the growth of the portfolio or utilized to fund the costs of living. The significance of investing in the stock market is further highlighted by the presence of inflation, an additional factor. Because the purchasing power of money decreases over time as a result of inflation, it is vital to invest in assets that yield returns that are higher than inflation. The stock market has, throughout history, generated returns that have been higher than the rate of inflation. As a result, it is an extremely useful instrument for both the preservation and expansion of actual wealth. For instance, even if inflation may increase by 2 to 3% on an annual basis, equity investments have historically provided average annual returns of 7 to 10%. This ensures that long-term investors are able to keep and even increase their purchasing power. When it comes to the impact that the stock market has on your wealth, the psychological component of investing also plays a crucial part. Extremely emotional responses to swings in the market, such as panic selling during market downturns or exuberant buying during market booms, can result in decisions that are less than ideal, which can lead to the loss of money. As an illustration, investors who liquidated their shares during the financial crisis of 2008 frequently missed out on the ensuing market recovery, so securing their losses rather than reaping the benefits of subsequent gains. In order to successfully navigate the ups and downs of the market and achieve financial success, it is essential to maintain discipline and a long-term view. The stock market has become more accessible than it has ever been previously as a result of the democratization that has taken place in recent years. The entry hurdles have been lowered thanks to the proliferation of platforms that provide automated investment, commission-free trading, and fractional shares. This has made it possible for individuals with minimal funds to engage in the market. The greater accessibility of the stock market has made it possible for a wider variety of individuals to take advantage of the potential for the stock market to develop wealth. Apps such as Robinhood and Acorns, for example, enable users to invest small sums on a regular basis, which makes it simpler to accumulate money over time through constant contributions and the force of compounding. Not only does the stock market have an impact on individual wealth, but it also has an impact on the economy as a whole. This acts as an indicator of the state of the economy, representing the performance of firms, investors, and consumers, as well as their confidence in the economy. Stock prices that are on the rise typically improve consumer confidence and spending during times of market boom, which in turn contributes to the expansion of the economy. On the other hand, market downturns have the ability to weaken consumer sentiment and lead to decreased expenditure, which might potentially generate broader economic obstacles or difficulties. These macroeconomic trends have the potential to have a direct influence on personal wealth, as they can have an effect on aspects such as the income and job security of individuals, as well as the value of other assets such as real estate. The stock market is a powerful engine for the generation of wealth, creating prospects for growth, income, and financial security. In conclusion, the stock market is a powerful engine. However, the extent to which it affects your wealth is contingent on how successfully you negotiate its complexities and manage the dangers associated with it. Utilizing the potential of the stock market to grow and maintain wealth can be accomplished through the adoption of a disciplined investment strategy, the diversification of your portfolio, and the concentration on long-term objectives. Investment in the stock market continues to be a crucial component of any comprehensive financial plan, regardless of whether you are putting money away for retirement, trying to generate passive income, or trying to outperform inflation. Thanks for watching. Don't forget to like and subscribe to our YouTube channel.